Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. I'm Jason McIntosh. It is Friday, the 4th of March 2022. As always, this is general commentary and doesn't take your personal situation into account. All right, with that said, let's get straight into our first chart. Now, look, as I'm recording this, volatility is starting to pick up. I've seen reports about shelling of a nuclear plant in the Ukraine, and this is starting to unnerve the market somewhat, and we're seeing some volatility during the Friday session in Australia. And look, this is a volatile and it's an uncertain time, and there's naturally a lot of fear and a lot of emotion coming into how people are approaching this market. So hopefully over the next 15 minutes or so, we can step back and we can look at these markets objectively and not emotionally. Now, there's plenty of scope for me to get things wrong here. There's a lot of movement, there's a lot going on, but I think we may have seen a notable low in the US market last week, and in the Australian market as well, for that matter. I'll talk a bit about that in a few minutes. But what we've seen here, we've got this. We had this spike low. We've seen the market rebound quite strongly, and it's been grinding high this week. It's messy, it's choppy, but it's been holding in there. And just from my read of the technical state of this market, and also other indicators which I'm looking at, suggests that maybe we do have some sort of an important low, at least a temporary one. And so what I've been seeing reports of there's been a lot of hedging activity in both globally, really. There's been a lot of hedging going on, but particularly in that US market, I'm seeing reports of a large amount of put buying. So when people buy a put option, they're either hedging their portfolio or they're speculating on further downside. And what we're also seeing is we're seeing a lot of volume going through those inverse ETFs, so those bear market ETFs, where when you buy an inverse ETF, the price goes up when the market falls. So it's a way of hedging a portfolio. So I want to show you what I mean. I want to just quickly jump over and show you this ETF. So the ProShares Short S&P 500 ETF. Now, what I'm going to do, I want to put a volume indicator on this, and then I want to put this onto a weekly chart. So I want to compare this to another key part of history, and this was the COVID crash. So I want you to have a look at this. I want you to compare the two. Compare the volume profile from the COVID period to the current period, and you see that they're quite similar. But this was a full-scale crash. This so far is like a 15% decline, and people are so on edge, I think, that they've been very eager to start getting hedging in place in their portfolios. So, from the way I see this, the market the market's just not set up for a crash, because crashes are blindside events. They come from left field, they take people by surprise, and they cause tremendous damage to portfolios. When you get a situation where a large portion of the market is getting themselves either hedged or in cash, that's not so much of a market crash setup, because people are ready for it. You can't blindside a market that's prepared. It doesn't kind of work like that. So rather than a crash, what I think might be happening here, let me just jump back to that S&P chart. Jump back to the S&P. There we go. And I'll just get rid of the volume. We don't need that here. So what I think might be happening is I think this market could be setting itself up for a short covering rally, or maybe it's a hedge unwinding rally. And these rallies, when they happen, they can go a long way, and they're quite volatile. So they're not just in a straight line. They're up and down, and they're difficult. And they can last several weeks. So what we could possibly see happen is that we could see something like this over the next several weeks. So whether it's to that magnitude or whether it only got to there, I don't know. But let's just say we have the potential to see the market rally from here around 5 to 10% over the next several weeks. Whether it's from here or whether it has another fall, maybe it comes back down and gets close to this low point. But provided this low holds, that's what I think the market is setting up for. Look, as I said, lots of scope to be wrong on this, but I think this is something which we should have in mind with our portfolio positioning. So people now who are getting heavily hedged and going to cash, be aware that something like that could occur over the next few weeks. But look, as I've been saying the last couple of weeks, I don't think this is over. I don't think this corrective or consolidated period is over. And you see, markets typically correct in two ways. They correct in price, and we've been talking about price. The market's down 5%, 10%, 15%, what have you. And they also correct in time. And this is something you don't hear talked about quite so often in the time component. But that's a really important part of a correction, because it's the time part which brings a chart back into balance. And so I want to show you what I mean. To do that, I'm going to go to a weekly chart, because this will help put some perspective around what I'm talking about. So the average duration, let's talk about some averages for a moment. So the average duration of a bear market is about 30% as long as the average bull market. So this isn't, the S&P 500 isn't in an official bear market yet, and maybe it won't go into one. Maybe this is just a pullback within this larger bullish trend, and maybe we're going to go higher again. My leaning is that that's not the case. My leaning is that we've now started a correction of this whole advance. I think this whole advance is in the process of now being corrected. Could be wrong, but that's the basis of which I'm looking at this point in time. So let's just measure. Let's measure how long the advance took. So if we measure this out, the advance took, that's 93 bars. So it's just short of a couple of years. So, and then we look at what we've done so far, and that's it's not very long. We haven't pulled back very far, and we're not very far into it. So if you work out 30% of 93 bars, it comes to about 27 bars, or 27 weeks. 27 weeks. So if we put that on the chart, let's just measure out a 27-week period. Comes to, I'm just looking at the in that red box, I can see the number of bars which I've moved across. So there's 27 there. So it's possible that we're only a third of the way into this corrective period, if it is the case that we're correcting this move here. So now, of course, these things don't work with precision, and I'm talking about averages. So it's only a rough yardstick. Things can move either side of the average by considerable margins. This is only giving us a guide to how things could play out over the next maybe the next couple of months. And if we were to see a correction within here, we don't know what's going to happen if it's within these bounds. Like, all sorts of things could happen. The pathway the market could take. But one of those possibilities is the classic zigzag. We get the ABC decline. A, B. B could be the short covering rally. Maybe if we get that short covering rally, maybe it's the way B within the zigzag, and then you get the C decline in a month or two, potentially. Like, none of this is all. It is crystal ball stuff, because nobody knows. It's looking at the possibilities, but looking at historical precedent of how these things can work through. This is certainly one of the scenarios which is on the table. And then, of course, the other side to these corrective periods. So that's time. So that would be like the time frame which this could take to work through. Then the other side, of course, is price. So let's put the Fibonacci's on this move and give some ideas. So if we did a Fibonacci retracement of this entire fall, of this entire gain, well, then we could see this market come back to around this 3,800 sort of mark. That's around the 38.2%. And just giving let's just work out like how far that is. That's that's about 20%. And I do think this market has the potential to give us that 20% correction, which has been spoken about for so long in so many areas. People saying, oh, the market needs to do a 20% correction. Well, maybe this is the time, and maybe this is how it could potentially play out. Another thing the market will potentially do is like look at this blue line is a 100-week moving average. So I just want to scrunch this up a little bit, go back in time. And if you just look at the touch points along the 100-day moving average as we go through time, you'll see that it comes back to the 100-day moving average maybe once in every 1 to 3 years. So it's now been around 2 years since the market last fell below the 100-day moving average. So maybe that is part of this corrective period. Maybe it gives us a guide that this market needs time and it needs a bit more in price if in fact it is a correction of this larger advance. So it's going to be interesting to watch how this plays out. While I do think there is a potential that we get this that we do get a strong bounce over the next it could be the next few weeks. Its time frames are so hard in this because we just don't know. As I keep saying, it's like just working out possibilities. But if we do get that strong bounce, I would be inclined to be selectively buying stocks, but I don't want to rush out and buy everything because I think there's a lot of risk in this market still. So I'm avoiding stocks that are trading below their 50 and 100-day moving averages. I think they're the riskiest plays in this market. And if we do see a strong rebound, there's going to be the temptation to buy some of those fallen favourites that have come back a long way. So I want to give you, just going to quickly run through and give you a couple of examples of the sort of stock which I'd want to avoid in this period. So look, one example is Domino Pizzas. So this was a real winner during the COVID period, and you can see it had this really strong rally during 2020 into 21, then started to lose momentum, and the moving averages crossed. Actually interesting. I've got these markings on the chart from when I spoke about this. We spoke about this a couple of months ago, I think. Maybe it was around here. The price had just broken below support, had broken below a trend line. And my point at the time was dangerous time to be buying a stock like Domino's because the momentum shift and it's breaking down. It's not a time to buy the dip. And that's in fact exactly how it's turned out, because the vulnerability of this stock has been to the downside, and it's fallen lower. It's down another 20% since where I was speaking about it here. And the temptation always is when you get a stock down here, people say, "Oh, look, it's come back. It's come this far. It was such a great stock a year or two ago. It's going to go back up." But once those moving averages cross and the price is below the moving averages, it becomes a case often of it's sell the rallies rather than buy the dip, and that's what's happened in Domino's. I'll give you another example. This is another stock which did really well during the COVID rally period, and Domain Holding Group. So what we had when the moving averages crossed, we got a great upward trend, but then look, conditions changed, and they always do at some point. So once those moving averages crossed, this became a dangerous stock to be buying. So look, I'm sure a lot of people would have seen this stock here and thought, look, it's down 25, 30%. This is a great time to buy the dip. So we had the initial attempt to buy the dip, and people would have been thinking, well, look, it's starting to recover. It's time to buy. Look at the moving averages. The stock is below the 50 and the 100 day. So it's not a time to buy, it's a time to be careful. And this was a time of sell the rallies. And of course, this is what's happened. It's continued lower. Now, of course, stocks will ultimately bottom and they'll be below the moving averages. So at some point, these stocks do rise. But the path of least resistance whilst the moving averages are trending lower is for the stock to trend lower. So it's a dangerous time to be buying the dip. I'd rather wait. I'd rather wait for a stock like this to base, start turning higher, wait for the moving averages to round higher with it, and then that gives you your entry point. And this is the sort of stock I want to avoid during this period which we're currently in, because they're the most vulnerable. And I'll just give you one more quick example. TPW, Temple and Webster Group. So this was another boom stock, which huge gains in this, from $1 up to $14. But then the moving averages, look, the moving averages turn, the momentum shifts, and it goes from buy the dip to, buy the dip is through this period here. As the market's rising, it pulls back towards the moving averages, buy the dip, buy the dip, buy the dip. Even here, you could still say buy the dip. Once we're below the moving averages, it becomes sell the rally. Sell the rally. Sell the rally. Sell the rally, sell the rally, and it's declining. So even here, I think it's a case of sell the rally. Don't buy the dip. Buy the dip can be a great strategy, but you just got to know when to apply it. This is a risky situation. There are lots of stocks in the market like this now. So that said, there are stocks which I think you can consider. So I'll give you examples of where I am looking at potential opportunities. So Rio Tinto is one example. So Rio is a stock my motion trader service signaled a couple of times in the last 2 months. Moving averages have crossed, shares have broken to a 70-day high. Momentum has shifted to the upside. It's now a case of like buying into that momentum. And this is like commodities doing well. We don't know, of course we don't know how the next few months are going to go, but if we're buying stocks, I'd rather be buying a stock like this, which is showing strength. It's above its moving average. It's trending higher and has potential to continue running. Another stock which I've had buy signals for through my motion trader service recently has been Woodside. So Woodside is an oil stock. So you can see there was a time through this period here, there was a time to just leave it alone. But we do have the moving average cross now, and we do have the momentum shifting to the upside. And I think I got a buy signal somewhere in here for Woodside, and recently, I think we've had another one recently up through here somewhere. So look, it's a stock which is trending higher, has momentum on its side. And just briefly, and I'll come back and talk about gold again in a moment. But another one which was interesting, which I saw recently come up in my buy signals, was Anglo Gold. This is the Australian listing of Anglo. Again, we've got those moving averages crossing, and this is a sort of stock I want to be buying. I want to be trading with the trend, not punting the low point in something like Domino Pizzas. So this is just that difficult part of the cycle we're currently in. I think this is all about it's about capital preservation. It's so important during these periods. So it's about forgetting bold moves like trying to buy Domino's or Domain or one of those fallen market favorites, and it's about being selective in what you buy, and it's about doing what you can to ensure you come out the other side with much of your capital intact. And as I often say, the winner in a bear market or in a correction is the person who loses the least, who has the strategy to exit stocks when it's time to exit, and to avoid buying stocks which are in downtrends. And that's what I'm trying to help you guide you through these videos and with my motion trader service. Now, just quickly, I just want to duck over and have a look at the ASX 200, and let's just go straight to the hourly charts on this one here. So look, last week we were down here, and I was saying, look, it just felt like this market was struggling to break these lows, and felt like it needed some sort of an upward reaction, and that's what we've had during the week. It hasn't been plain sailing by any stretch. It's been a very volatile, zigzagging path higher, and it's still doing that. But this is what I think the situation we're currently in now is, that these markets they've reached an oversold state where a lot of the people who wanted to hedge or sell have sold, and we could be at the point where it does spring back in the other direction. And as I said, look, I'll consider opportunities in these markets, but only stocks which are above their moving averages. I don't think now's the time to play the hero and go in and start buying up stocks which are down a lot, because maybe they don't rally back so well if we do get a snapback, and there's no guarantee we get a snapback rally either. It's just it's a possibility. It's a possibility based on what I've seen in the past and on the historic precedent of how these moves often play out from a time and price perspective. So let's go over. I want to look at gold this week, because gold's been really interesting. It's this is the big range we spoke about last week, which gold has broken out of, and it's continued to trade really well. The question now is gold going to pause around here, or is it going to keep rallying? So my preference for, the market doesn't care what my preference is, of course, but what I'd like to see gold do, I'd like to see gold consolidate. I'd like to see it come back and do some work in this region here, and then see the buy the dip traders come in, support the price, and then start to push it higher, and then get another breakout. That's textbook. That would be great, and that would give a lot of confidence in buying a breakout through there. It's putting the Fibonacci's on, that would bring it back into the Fibonacci range. Maybe that 1870, 1850 sort of area. That would be nice to see gold do that, because what consolidations and pullbacks do, firstly, they're completely normal following a breakout, but also they're really healthy, and it helps increase the likelihood that we get a sustainable, big, medium-term advance, which I think is very much possible for gold at this point. But look, we need to see how it plays out here. The concern I have, the one nagging concern I have, is that this is very much catalyst driven. It's been very much driven by tanks rolling through streets, and people see that and they buy gold. One possibility is that if the hostilities do die down, and the tanks start going home, that the people who bought gold on that basis start selling, and then we get the price fall away. That's a concern. That's a possibility. It's a scenario. It's not the base case. I think, look, we've got a clear breakout. I think we do need to go with it, but it's being aware that there is a lot of catalyst-driven price action and buying going in here. That's why I'd like to see the pullback find support, find fresh buying, and then start to push the price action higher. That would be a great development for gold. So we just have to see whether it does play out like that. So just looking at an opportunity in the gold sector, I want to go over and just quickly have a look at let's have a look at North Star. So North Star is a large ASX listed company, and so what I want to do with this, I had these on from something previously I was looking at. So what I want to do with this is, let me just paint the picture with North Star. So this looks, North Star's price action looks quite similar to that of other gold producers, other big companies like Evolution, like Newcrest, two of the large big Australian producers. Also resembles a lot of the mid-tier North American stocks. Have all got this same pattern. We've had a big move down. Then over the last year, we've kind of travelled sideways in this wedging-looking formation. So I'll draw a wedge on this chart. Now, this isn't a true wedge. It's not a proper wedge. It's not how you draw a wedge. But I just want to focus your attention on the narrowing of the price action. So I'll explain a little bit more in a sec. So if we draw this in like this, so this is not how you draw a wedge, because you don't have these bits sticking out either side of it. But it is wedging price action in that you can see that the price action is coming through here and it's narrowing. So it's a wedging type of price action, even though the pattern's not properly formed. And what we have is we've recently had the breakout to the top side. So this is looking really encouraging, and it's just been tracking sideways over the last few days. So look, maybe if we see this continue to just track sideways and then start to break upwards, that's going to be looking very interesting on the chart. We've also got these moving averages are close to crossing, so I'm close to getting a buy signal for North Star, Evolution, Newcrest. They're all in there. A lot of those North American ones, they're all shaping up with this sort of pattern. So look, I think, and they're also breaking up off support. So we've also got like lots of support through. This is really rough and ready, but yeah, we've got support through there, which with North Star's breaking off, bouncing off, and you can get the same sort of support region on quite a few other stocks. So I think yeah, look, as I said with gold, I think we've got to look at this break, we've got to run with this break and see where it takes us. And also I think this is shaping up as a very asymmetric risk reward trade, in that your upside is up here, but your downside risk can be managed with stop losses just below the price action where it currently is. So your risk reward is very positively skewed to the upside. Doesn't guarantee it's going to work out, but that's the way you want to play your odds. You want to play your odds where you're getting a lot of upside, but you're managing your downside. That's how you make money in markets. And a lot of people do it the other way. Small upside, but don't use exit stops and have big downside, and that just doesn't work out too well. So very briefly, I'm going to have a quick look at uranium. That's been very interesting since we spoke last week. Last week we spoke, it was just here, continued to break higher. Going to be interesting. By the time you watch this, you're going to see Friday day in the US. It's quite possible we're going to see uranium pull back tonight with this talk of shelling of nuclear reactors. So let's just see what happens. But what's going to be interesting here is what happens if and when uranium comes back. Is it supported, and does it start to push back higher again? That'll be a telling sign to see whether there's underlying demand to support the price and buy it on a dip. That's what we want to see. We want to see the price. If the price does come back, we want to see that pullback bought and the price start to move higher again. That'll be a real good sign that uranium could be on the move to higher levels. Alternatively, if we fall back down, we could just be stuck back in the range. We'll have to see what happens. So bit of a key pivot point for gold tonight, for uranium tonight, to see how it handles this current news we have coming out. And lastly, I'm going to finish on copper. So I've got to touch on it this week because stuff's happening. It's don't make the video too long, but when things are happening, you need to, we want to have a look at it. So this is a big range we've been looking at in copper for ages now. This has been in place since back in May last year. So we had this great rally over 1 year in copper, and now we've had the big consolidation. Now we seem to be getting the breakout. So look, let's watch this with a lot of interest, because this has a potential. If this breakout sticks, we could consolidate, but it could be off and away. It could be this could be something really important happening in the copper market from a price perspective, and we could have some good upside coming. And it is very interesting because we spoke about, I think it was 3 weeks ago, we spoke about this stock here, the global copper miners ETF, COPX, listed in the US. It was just here we were talking about it on Trade the Trend, and we talked about how this had broken high, had broken to a what was that? I don't know what that was. It was like a 9-month high or something. It was above the moving averages. Looked like it was getting momentum, and that's continued to be the case. It's continued to rally, and we spoke about at the time we said, look, is this preempting a break in copper? And it looks like that's very much what's happened. So look, going back to what I said earlier, if you want to be buying things in this market, I think these are the things you want to be buying. You want to be buying the stocks with momentum to the upside, which are trading above their moving averages, and that's where I'm seeing the opportunities. They're coming up in my motion trader service through the algorithmic signals, through the scans that I'm doing, and just when you go through the charts, you can see the setups, you can see the ones which offer offer that potential, that upside potential, with where you can manage your risk. And so look, let's leave it there for this week. It's there's a lot going on, and hopefully that helps put some clarity around where we are and some perspective. Let's come back next week and let's see where we are and try and put all those pieces together again. So thanks for joining in. Been great talking with you. See you next week.